Does it matter that the U.S. government is insolvent? They have no money. So where do they go to get money? They have to take money from the private sector to finance the debt and deficits and the interest on the debt, which is now $1 trillion a year. And again, the catalysts are there. A very positive real Fed funds rate, the ending of the bank term funding program, and the reverse repo facility running dry. Those are your catalysts. Doesn't guarantee it's going to happen.
Michael Pento, a veteran money manager and the brains behind Pento Portfolio Strategies, is casting a spotlight on the shadow looming over the financial markets, a potential credit crisis that could unravel the fabric of our economic stability. The imminent end of the bank term funding program, coupled with the urgent need to refinance a massive pile of commercial loans at steeper interest rates, poses a grave threat. This scenario is further complicated by the existence of numerous zombie companies, barely surviving entities that could lead banks into a precarious situation due to an unprecedented rise in the cost of borrowing. Pento's analysis doesn't stop there. He draws attention to the stock market's current valuation, asserting it is inflated by as much as 40%. As the artificial support from quantitative easing begins to fade and the Federal Reserve's balance sheet contracts, Pento anticipates a liquidity crunch that could trigger a broad market correction. His foresight into these matters suggests that the economy is skating on thin ice, with significant adjustments on the horizon as we navigate towards a potentially turbulent financial future. Now, we'll show you more clips, but first, like, subscribe, enjoy the video.
Commercial real estate loans coming due in the next 2 years. So the banks were in trouble when they launched the bank term funding program in March of 2023, and things are much worse than they were when they first launched the program. So I put out a tweet the other day about the real Fed funds rate, and the real Fed funds rate went from minus eight to positive 2 percentage points this time around. And every time in the past few recessions, when the real Fed funds rate, so the nominal rate minus inflation, poked its head above 2% and stayed there for about a year, we had a recession. Well, we're about 9 or 10 months now of a positive 2% real Fed funds rate. And again, in the other instances, the negative Fed funds rate was, maybe just slightly negative, maybe -1. It was never -8. We went to ZIRP, zero interest rate policies, and had a 9% inflation rate, 9% inflation rate. So this is an unprecedented increase in the cost of money. And the banks are hurting because their loans that they've made, most of them were real estate related loans, especially on the regional banking sector. They had their assets taken from them, and the 10-year note is higher than it was when the assets were first taken from them. And mortgage-backed securities, the mortgage rate now is 7%. It was 6.6% back in March of 23. So the banks are in trouble. 4 banks went under in 23. The Fed bailed them out, and that program ended on March 11th of this year. So, and last week wasn't a great week for the stock market. I anticipate a liquidity impulse that will be greatly negative. Starting, it's not going to be a trenchant, watershed moment like it was, say, Michael, March 12th, you said the liquidity crisis is coming. What I am saying, Dunnigan, is that the reverse repo facility, now it has $400 billion in it. It started with $2.5 trillion about a year ago. So that should run dry around June. And then all of the easy money that's been pouring into the stock market from the offsetting bank term funding program and the reverse repo facility, that actually wiped out QT. So QT has been draining the Fed's balance sheet. And the QE coming from money that was fallow at the Fed and the reverse repo facility coming into the stock market and the bond market has more than offset the QT. So you actually had a form of QE, about almost $1 trillion worth over the past year. So that ends in June. And then I would expect to see some reality come to this very, very frothy stock market. In fact, my estimation is that the stock market is still 40% overvalued. So I expect reality to come. I'm monitoring financial conditions. They've stopped easing. They're not tightening yet. But before they can tighten, they have to stop easing. So last 4 weeks, financial conditions have stopped easing. So I'm myopically focused on that. And I'm also looking at credit spreads. Credit spreads have yet to widen. I expect that to happen again late spring, early summer.
Silver outlook. Will silver eclipse gold amid rising inflation? Silver defies norms, climbing 3.60% despite strong dollar and treasury yields. Fed's upcoming policy decisions critical amidst persistent inflation indicators. Silver ended last week on a high note, closing at $25.19, marking an increase of 0.87 or 3.60%. This upward movement significantly contrasted with gold's modest decline. The trend propels silver towards testing recent highs of $25.91 and $26.14. Differing from usual market patterns, the U.S. Producer Price Index reported a 1.6% year-over-year rise, primarily driven by escalating energy costs. These figures indicate persistent inflation, suggesting the Federal Reserve may extend its tighter monetary policy. The upcoming Federal Reserve meeting is highly anticipated. A hawkish stance from the Fed, suggesting higher interest rates, usually signals a decrease in silver prices. In contrast, a dovish Fed could increase silver's attractiveness by lowering its global cost. Now, we'll show you more clips, but first, subscribe, enjoy the video.
Seeing, you see that was 7 stocks. Now it's about 4 stocks. The Magnificent Seven has become the Magnificent, 4 or 5 stocks. So the breadth is becoming more and more narrow. And every time in the past you've seen that happen, whether it was in the Nifty 50 in the 70s, or if it was the NASDAQ stocks in 2000, every time a very small number of stocks lead the gains, it's led to disaster. Now, that's not a timing tool, though, Dunnigan. So again, I think I've been doing this for 33 years. So I don't think I'm an idiot. You can ask some people. I'm sure they think I am, but I don't think I am. And I manage a lot of money, and I have a lot of money personally. And I don't want to get blindsided by either being short the market too early or out of the market completely and miss out on gains. But the idea that the stock market always goes up and you just need to buy and hold a diverse basket of stocks and bonds, it's just ridiculous. I mean, if you look at Japan, their market just broke even. I probably mentioned this before, but it bears noting again that their market topped out in 1989. So 35 years later, it got back to even. The Shanghai Composite Index is down about 40% since 2007. That's 17 years ago. So unless you think the laws of supply and demand are different here in this country than they are in every other nation on the planet Earth, I mean, by the way, we've had lost decades here in the 30s and 40s and in the 70s. So you just can't buy and hold a bunch of stocks in a diversified portfolio in these target date funds and hope that your retirement is going to be sound. I just won't do that. Again, I've learned through my multi-decades of managing money, you have to be smarter. And that's why I created my inflation, deflation, and economic cycle portfolio. And it tells me when I need to get nervous about the stock market based upon the scoring of that model. Right now, I'm on high alert. Not high alert. I'm on alert because of the valuations of the stock market, because of the liquidity impulse, because of what the Fed has done, because of positive real interest rates, because of the ending of the BTFP, because of the reverse repo facility, because of the insolvent condition of the United States of America. There's a lot of things to be worried about. The fact that most of the gains are in a handful of stocks. The fact that the stock market is at 185% of GDP, which is unprecedented prior to 2020. Never, not even 1929, or the year 2000, or the year 2007 was the stock market, the valuation of stocks compared to the economy, ever close to 185% of GDP. Never. But it is today. So if you're not worried, then you're either stupid or ignorant. I don't want to be either one of those things. So getting the timing right is crucial, and that's why I come on your program. I am not. You're going to ask me. I can feel you ask me. Well, are you short yet, Michael? No, I am not net short the market yet. I have only one short, and that's in high yield, and it's a 2%. So I have no direct shorts in the market, but I'm anxiously waiting to put more shorts on. I'm patiently waiting and anxiously waiting to put more shorts on. But I'm going to do it when the market is ready to fall, not when I read some headline and get nervous and hit the sell button.
What do you think of Hemke's way of trading the bull market? Are you actively trading your positions, or do you just stack and hold? Post it in the comment section down below. Subscribe if you have not yet done so, and watch this video right here because you'll love it. I see you on the other side.